Well, here we are, TK, QAV 430. How are you going today?
Yeah, good. Lockdown continues. Oh, man. And for a long time to come, I think, too.
I think they're Gladys is supposed to be giving an update soon, but 145 new cases in New South Wales yesterday, I think. So,
yeah, plus a big protest in the streets, which I'm thinking is going to spread it further.
No, that could never happen. There was a big protest up here too, 7,500 people on the weekend. And of course, we've got a guy who we found out flew from Sydney to Ballina while infected. An air stewardess, hostess, I don't know what they're, flight attendant, I think that's the official term these days, drove across the border. She flew up as a flight attendant, drove across the border, picked him up from Ballina, got infected herself, drove him back across the border, and then they were both walking around here for a week, lying to the authorities about his coming from Sydney. Went to Chermside, number of, big locations here, so it's only a matter of time before we're in lockdown here too. I don't know, man.
Yep. So what are they protesting? What are they protesting about?
Who the hell knows?
No
we haven't had any lockdowns. That's what I want to know. They're protesting the fact that there might be one day, if they do a good enough job with these protests, not wearing masks, there will be a lockdown. They're pre-protesting the fact that they're going to send us into lockdown by being a bunch of morons. Anyway, I want to thank Gary for leaving a review on Apple Podcasts for the podcast. Appreciate that, Gary. I've been begging people to leave us reviews for the last couple of weeks, and as far as I know, Gary's the first person to do that, so thank you, Maestro Now, for doing that. That's Gary's username.
You mean you haven't been logging on under false names and leaving reviews?
No, I don't feel desperate enough to have to do that, but I haven't even done that for the film or the book, Tony. But no, if anyone wants to leave us a review, there's a link in the bottom of the weekly newsletters. Just go and click on that. Apple or Spotify, just leave us a review. It helps. Because people, if they go randomly searching, they see a podcast, shall I listen to this? I don't know. It's going to depend on how many positive reviews it has. So take a minute, give us a review. We'd appreciate it. Emphasis of matter time, Tony. MIL, Millennium Services. Now, I was doing my own scorecard last week because I had to sell something, MTO, I think, and figure out what I was going to replace it with. And then I was looking at MIL and I noticed this emphasis of matter thing, which I didn't think you'd mentioned when we did a bit of a deep dive on MIL a couple of weeks ago. It says emphasis of matter related to going concern. But reading through it, I couldn't really tell if it was a problem or not.
Yeah, I think it is. Well, yes and no. I mean, I think I've stuffed up. Quite frankly, I think it shouldn't be on the top scorers list because that kind of emphasis of matter is a highlight by the auditors telling you to look at the notes in the financial statements which say that there's a question mark over the company's ability to continue trading as a going concern. So that is the classic red flag qualified audit statement. So I don't know how I missed it, but I did. I know when I was doing the deep dive last week, I didn't check the audit report because I assumed I'd done it correctly in the past when it was added to the top scorers list and even added as a stock in the dummy portfolio. So a complete oversight on my part. I'm not sure how to explain it. I've been racking my brains trying to recreate my thinking back then, but I just think it's an oversight. So
Negronis. It was Negroni time, Tony.
I don't think so, but so I stuffed up. I'm going to fess up. I think it's going to be. It highlights the fact to do your own research and check things for yourself, and don't rely on me or you or anybody else to do it for you. But I think this kind of problem will hopefully be solved over time if we can automate checking the audit report somehow. So that's got to be something we direct some attention to. Try and get a way of doing it automatically.
Well, I think it's a good thing in a way, as you just said. Like, we've been urging people for the last few weeks to share their scorecards. And I tell you, the reason I came up with MIL is because it wasn't on my scorecard. And a couple of people, I think it was Alice and Cosman actually, who pointed out that it wasn't there and asked why I had skipped it. And when I went back and checked it, I noticed that I had it down as in my manual data from the last time I looked at it, probably a month ago. I had it down as having a qualified audit, and I'd totally forgotten when you did your deep dive on it. But again, it was the fact that I picked it up this time when I went to double check it, because the community checked my scorecard and pointed out a couple of omissions. I went back to double check the omissions, and then I could go back to you. So, you know, it bloody works, Tony. There's power of having 150 odd really smart people on our Facebook group that are checking each other's work, you know, and reviewing stuff. It's terrific. I mean, I'm really excited by the fact that they're picking up mistakes and errors, and we're folding it all back in, so we're all getting better results. It's really terrific stuff.
Yeah, I agree. It's helpless on this occasion. It's good.
Yeah.
I just probably should go on to say that I'm leaving it in the dummy portfolio, and that was a decision I had to think about, because normally I'd take it out. It's a red flag event. It's a go, no-go, pull it out. But I suspect, given the circumstances with this particular company, the going concern question was raised because there was a lot of current debt and not enough current assets to cover it. However, there was a lot of current debt because apparently there's an accounting rule which says if you have long-term debt which is being renegotiated during the 12 months that the financial report refers to, then you have to classify it as current debt. And so there was lots of, I think it was like $20 million worth of debt had been transferred from long-term to current, and there was only a couple of $1 million worth of current assets. And so they were saying, well, you can't pay your debts. But really, I guess, as we saw with this company, they've had a restructure. They've had lots of JobKeeper payments. They paid down a lot of debt since that audit report. And, you know, they're on a better footing going forward. So I suspect that the audit won't, I think it'll disappear with this next reporting period, which comes up next month. So we'll wait and see. If it's still there, I think I'll probably sell it. But at the moment, the share price is going up, and there's a reason behind, you know, why I think the qualified audit may go away. So I'm just going to hold it until we see.
It's come back a little bit over the last day or so. I think it's dropped 3% today, 3.3% today so far. Still up 1.75% since we bought it, but we should keep an eye on it.
Yeah. Yep.
Okay. MXI. I think it was Cosman on the Facebook group also pointed out last week. He was the first person to point out that MXI had been put into a trading halt.
Mm-hmm.
And then a day or two later, they announced they were selling their trailer business. It shot up 30-odd% in the day, which made me very happy and Taylor very happy because we held it in our portfolios, and his mate Chris all very excited. I know a lot of other QAV folks are holding it as well. So that was a nice one.
Yeah, good. Must have been a bad business, that trailer business, to sell it and shoot the share price up.
Yeah. So I wanted to ask you, is that something that you think has anything to do with QAV picking up, that it was right for that kind of a turnaround, or is that just a purely coincidental luck thing?
Gee, good question. I don't know. I think it's due to, like, when we see companies pop up on our QAV top scorers list, management are going to work pretty hard to get the share price up and get, you know, the price back to where they think fair value is. Mm-hmm. We're looking at companies which are undervalued. So I think this is an example of action taken by management to try and improve the share price of the business.
So they think it's undervalued as well, and they're sitting around going, okay, we have a responsibility as directors of the company to work out what we can do. Why are you laughing?
No. They're not thinking about directors' responsibilities. They're going, shit, our options are underwater. Let's get the share price up. Or something like that. Or we own shares in this stock. Let's get this puppy on the road. Come on.
Well, when we have a responsibility to the shareholders, they mean themselves to, release the value in a business. And they figured in this case, the best way to do that was to sell the trailer business.
Yeah, exactly.
So there is some merit in saying that QAV is uncovering these businesses that we think are undervalued, and if we think they're undervalued, it's a good chance that other people do as well, either the directors or other interested parties in the case of acquisitions or that kind of stuff.
Yeah, as we've seen before, it's fairly common that a QAV stock gets taken out by someone else. I think the most recent example was Australian Pharmaceuticals, API, which is under takeover offer from Wesfarmers. It's the chemist chain.
Right.
It was on our top scorers list. It's dropped off the bottom, I think, because of price rises. But, a company who's made a whole career out of taking over other companies has seen the value just like we have. And
the other example would be Myer. Of course, I added it to my portfolio, and then Solly Lou, who we know is a big fan of the show, snapped it up and started driving the price.
I think Solly pays someone to listen to the podcast for him.
Of course. Yeah. As I do. In fact, this isn't actually me right now. This is somebody impersonating me. I've hired an impersonator to impersonate me. I'm actually lying in a hammock drinking Negronis out the back. All right, MTO. MTO breached its sell line on...
I was going to ask who you hired to impersonate you.
Oh, it's just a guy. I found him on Fiverr. Just doesn't impersonate. No, he doesn't have to do anything. Just has to read questions and tell some bad jokes, and it's all good. MTO breached its sell line on Thursday. I sold it out of my personal portfolio, but I got to tell you, I was a little bit unsure as to whether or not I really wanted to, because the chart looks good. It's still going up, and then it came back, but I thought it did breach the sell line. But I was like, it's one of those charts that's breached the sell line, but is still generally going upwards towards the right.
Yeah, right.
If you look at it over... Well, since the sort of COVID cough, right, it's been building back up. Mm-hmm. And listener Dan sent me an email about it too over the weekend. Hey, mate, MTO has breached its sell line, but I'm feeling a little reluctant to sell it on the basis I think it's doing quite well. Mm-hmm. I'm still learning. It could be quite wrong, but there's some big pluses for me and a couple of slight negatives. They've been accumulating a lot of cash on the balance sheet. That cash has been used to pay down long-term debt to zero. Came out with an earnings update, which they think will be up around 50% on the last results, expanding market share by opening new stores, which are apparently doing well. Added subsidiary financially department, making them more profitable. Margins are expanding, making them more efficient. The downside, looking for an M&A which could turn into a diversification. Tailwinds of COVID lockdowns will tail off. Like I said, I'm only just starting out and could be way off in terms of my analysis. I'm wanting to hold off until September 28th on this one when the new figures come out, although it has breached its sell line. Would love to hear some feedback from the main man himself. So... Okay, breach is the rules is what I said to Dan.
Rules.
I sold it because rules is rules, Dan. But I was reluctant, like Dan is. I was like, look, it looks good, but so rules
all that analysis Dan's done is good, but the share price has dropped from 290 to 260 this month, so that analysis isn't counting for much with the current share price. And if you look at the graph, it's kind of started off steeply after COVID. Now it's tapering off and even turning over. So, look, I take Dan's point. I take your point. I think you said 29th of September were the results, but I think it'll be August rather than September. I think unless it has does it have what's its reporting date? Yeah, no, we'll get new results from this one before the end of August. So you can potentially wait until then. I very much keep an eye on the share price because there's been a fair few cases, I think, in the last month or so where we've seen stocks bounce off the COVID low, and even though they're in a general uptrend, the steepness, I guess, of that uptrend is starting to taper off and then sometimes turning over. And I'm thinking of stocks like VUK and ANZ at the moment, and even with stocks like we spoke about last week, the retailers like Adairs and JB Hi-Fi, they're kind of in a bit of a downturn at the moment. Of course, that might turn around with new figures, and JB Hi-Fi and Adairs haven't crossed their sell lines, whereas Virgin UK and ANZ have. So Virgin UK and ANZ are basically telling us that we should sell when they cross the 3-point trend line because they both remained beneath that the share price when they crossed. Other ones that I spoke about last week, like CBA, kind of bumps up and down against the sell price. So I'm having to watch that day by day. And I think we spoke about CBA last week. It crossed its sell price by a couple of cents and now it's back above it. So I haven't sold any, just as an update on that one. But it could easily turn around. It's so close to the sell price. It could turn around today or tomorrow. So I think rules is rules. You might want to wait for a little bit, like, give yourself a couple of percentage points tolerance and just see if it does turn around. But looking at the MTO graph, I think it's a reasonable conclusion to say that some of the wind's going out of that share price.
Really, even though it's been going up relatively consistently since the COVID cough?
Yeah, it has been going up consistently, and it may well keep going up. So there's never a black and white answer to this situation.
Yeah.
Yes. And like I said, if you wanted to wait and give yourself a bit of a margin there, you might wait till it's a couple of percent below the sell line before you sell, but in case it turns back up again. But I'm not convinced. In the last month, it's dropped a 30 cents on a 3, but it's dropped 10% in the last month. So it's a bit of a trend, I think, for me.
It has dropped a couple of cents since I sold it late last week, so I'm feeling okay about it. I replaced it with COG, which has come up a couple of points, I think, since I bought it, so it's all good on my end. But yeah, okay. Thanks for talking us through that. Let's talk about the sell line for MML, if we can.
Yeah,
Medusa. Sure. Hey, by the way, you told us last week to check our sell lines every month. I went through and did that when I was doing my scorecard last week, and I'm glad I did because some of them had changed some of them hadn't changed a great deal, but some of them had changed really dramatically since the last time I looked at them. They'd really gone up as the graph moves to the right, and so, yeah, glad I did.
Yeah, good.
So
occasionally, a trough or a peak will drop off the left-hand side of the graph as well, which will change it dramatically. Yeah. So
MML, if I look at the 5-year monthly chart for that, the low is June 2017, around about 28 cents. Then it goes to September 2017 at 29 cents, but those sort of are within an 8% variance.
Mm-hmm.
So I'm starting L1 at November 2018 at 31 cents.
No, I think that's L2.
Well, so what are you taking as L1?
The second. So let me just go through it. So yes. So I've got June 17 is 28 cents. And so we want a share price that's no more than 8% above that, which is 30 cents. If we're going to move the trough to the right because of the flat bottom. And November 18 is 31 cents. So that's why I'm using September 17, which is 29.
Yeah, you're right. Okay, so I want to start it there and I want to go through November 18.
Yes.
Which gives me a sell price of around 33 cents and it's currently at 91 cents.
Correct.
Okay, so that's a big drop.
Mm-hmm.
Okay, good to know. I don't know why I thought it was L1 was that one, but when I was doing it last week, must have been having chart fatigue.
Well, just one thing to note too. I know we talked about using the segment line drawing feature of Stock Doctor's graphs. I have noticed that, and that gives us a percentage when we click on it.
Yeah.
Which can help. But I have noticed when you're drawing these, you got to be careful that you're anchoring to the right price because, like say for example, we look at drawing an anchor on September 17. We want the price to be 29 cents, but you can actually anchor the start of that segment sort of anywhere from about 28 to about 30 cents and still look like you're at the bottom of that trough there. So just be careful when you're anchoring to a point on the graph. What I'm doing now is looking at the closing price for that particular month, which in September 17 case for MML is 29 cents. And then I'm looking across to the right side of the graph, and as I move my cursor, I'm trying to get 29 cents on the right side of the graph, and then I anchor it. So if you don't get that exact, it can make the percentage look wrong.
Yeah. Okay. Good tip. Okay. Let's talk about, the new shared manual data sheet that we've posted up on Google Sheets for QAV Club members. I want to shout out and cheers again to Gary for posting something on that. I think apart from you and I, he's the only person that's updated some data there last time I checked late last week. So thanks, Gary.
Can we just talk about that manual data sheet?
Sure.
So I noticed that, I think it was for COG actually, like you must have done this when you were buying it. There's the new 3-point trend line checklist item cell is a 1 or a 0, not yes or no. So just be careful that we're filling it out correctly.
Oh, whoops. What was?
Yeah.
I'm just bringing that up. What was the column?
So it's is the share price in the new 3-point trend upturn, or is it a recent buy? I think it might be called. So it's basically looking to whether the most recent buy is since the last financial results.
Okay, somebody's sorted the sheet
That was me.
alphabetical and removed the header column.
That would be me. Sorry.
Would be you. Let me just fix that.
Which was my next question.
Which is what?
Which is how did you have an idea of how we'd use this Google sheet? So what I did when I sorted it, sorry about that, I thought I'd put it back the way it was. I sorted it by the date that the last change was made, so I could go to the bottom and pick out the 2 or 3 changes that have been made since I last did a download.
Oh, okay.
Is that how you see it doing?
Well, I've just been searching for the stocks that I'm looking at to see what the last person said. But what I found was I didn't trust where it was at because I thought, well, qualified audit's okay, but at least with sentiment, I need to recheck the sentiment because it may have changed. Because sometimes the last time you looked at it was several months ago, like March in some cases.
Yeah.
So I ended up sort of checking most of them myself anyway, particularly if they're on my scorecard. Mm-hmm. But if I can check the manual, the qualified audit thing, if they haven't put out a new financial report since the last time it was checked, it should be valid, assuming somebody's checked it.
Yeah, I'm just thinking how I'm going to use this. I haven't used it yet because I haven't done a download since you posted the Google sheet, but I'm either going to use it one of 2 ways. Either copy the whole spreadsheet and just download it into my local version of the manually entered data tab on my master spreadsheet, which will allow me to do a download and then it'll give me a new top scorers list automatically. Or sort it and look for the most recent changes and update my spreadsheet.
Okay.
Which way have you done it?
Well, as I said, when I was doing the manual data section of mine last week, I was just searching for each stock and seeing if people had done it or if you'd done it because it was only you and, copying and pasting it where I thought it was safe to do so.
Yeah, okay. Yeah, I think the only issue will be is there's a couple, I think it's EVO maybe. No, WWR or WRR. Anyway, there's a couple of additions that have been added to the spreadsheet which you may not pick up if you're doing it. If you're looking through manually for stocks that you want to find out whether they've been updated recently.
Well, if they're not there, I just add them in, though, right?
So what are you doing? Sorry, you're doing a sort on price to operating cash flow, coming up with your list and then checking each one of those for a 3-point trend line sentiment, are you?
Kind of. I do the sort on price to operating cash flow, and then in the manual data tab, I'm using the Flipman version of the checklist. I stack rank for QAV score and go from the top down, and I'm also just checking, getting rid of any that have been picked up as having qualified audit previously.
Qualified audit, yep.
Yeah. And then I'm just making sure that the top sort of 30 stack ranked by QAV score have got their manual data done. And I'll just go down that until I find one that I don't already own. And make sure that there's, and go down a few below it, do their manual data as well, because sometimes that can kick them up above. But
yeah, exactly.
Once I've got a bit of a buffer there and I know that it's the highest, it's COG, for example, in this case, then that's it. I buy COG and I'm done.
Okay. Yep, that's not a bad way of doing it.
It's quick. It means I spend as little time as possible doing it.
Yeah, okay.
ABBA. ABBA are back, just with one B this time. I think this turned up on my scorecard. Yeah, that's it. ABA. Can we have a look at their chart for a sec? I got a little bit confused about this one because it's a bit wacky. So again, the low point, COVID cough, $4.32. This is Auswide Bank.
Right.
The next point, April 2020, is only 1% above that, 436. If I go up to July 2020, that's a 4.85% gap from the first low point. So I'm using that as L1. Is that
Which
kosher?
one, sorry?
July 2020.
Yeah, July 2020. That's what I've got too.
Okay.
Yep.
Okay, so if I then extend that through October 2020.
Yes, I agree.
It's giving me a sell price of about $6. It's currently at 6.23, and it's sort of been dropping since March 21. So it's come up a long way since the COVID cough, but I'm still checking that as like it's not negative sentiment, but it's in a positive sentiment with a downturn. We need a better name for that. What do we call that?
I don't know, a wait maybe? A wait to buy?
That's not fair.
I wouldn't rush in to buy Auswide Bank while it's in this kind of downturn. I'd want it to turn up before I did that.
Yeah.
And, it maybe the new figures might give us that, but it's approaching its sell line and it's trending down. So I'd be in no hurry to buy it. Yeah.
Yeah. Well, wait isn't very catchy term, Tony. We need to come up with something, sexier than just a wait.
Okay, well, that's your department.
Yeah.
You're the marketing guru. Yeah.
Okay, I'll come up with something of that.
Can you go and get Cameron from his hammock and come in and tell us what
This is the real Cameron? Yeah, no. He told me he doesn't want to be disturbed. Okay, let's look at WWG. I picked up WWG. Added it. It had relatively good score. I think it was 0.19 or something, but very low ADT, about $6,000.
Right.
Higher than GLE, but not by much. And I've already owned GLE. And you had a look at WWG and Wiseway Group. You confirmed that you think that's a buy for people with a very low amount to invest, maybe?
Yeah, I had a look at it. It looks fine.
Yeah.
A good pickup. It's been a buy for a while, I think, probably.
It's got a bit of an uptick too. It's going up at the moment, looking nice. Mm-hmm. So that's one. If people have got a relatively small investment portfolio like myself, you might want to have a look at WWG, run your own numbers, do your own work on that, make sure I haven't screwed anything up. Okay. Paul wrote in, says that he believes you're well on your way to earning an Order of Australia for your time and generosity putting into the financial future of others. TK for the OA is the new campaign that we're kicking
Services
off
to
here.
Negronis.
He also says, this is about the property leveraging stuff, I think, that you talked about in detail last week. Firstly, purchasing a first home is becoming more like a 10 to 15-year journey for many young couples, let alone singles. Tony's often spoken about it as the first step before beginning to seriously invest in shares, which must be rather demotivating for younger listeners for whom a decade feels like an eternity. I would have thought 10 years of QAV is the more likely pathway to a sizable deposit for first home buyers these days. Perhaps Tony might like to speak about that, and particularly timing around tapering off, de-risking when the house purchase becomes imminent, and also any wisdom on stock market and property cycles to time the exit from shares and the entry into real estate.
Yeah, look, I wasn't not trying to demotivate people by sharing that example of what I did. I think it's helped. I think it's motivating. I hope it motivates people rather than demotivates them. Yeah, start off with QAV if you like and get your deposit together. But I think there's also certainly probably doesn't have to be the start of your investing life. It should be a part of it. I think it'll help. The gearing will help anyway. It's much easier to gear against the house than it is to gear against shares because the shares come with margins, margin calls, which can happen, which can work against you. But anyway, a couple of points there raised by Paul. If I think about how I first started in property, the first investment property I bought, and this would have been in about 87 or 88, was a property in Seddon in Melbourne, in a sort of suburb near Yarraville and Footscray, and we paid $100,000 for that property, and I looked it up recently on realestate.com.au, and it's has a price estimate of $1.2 million. So that's in line with what I shared last week. It's gone from $100,000 to $1.2 million over 34 years, and that's about what we said last week. I said $1 million to $13 million, so that's pretty similar, and gives you an idea of how things will grow over time. But when I bought that house, I did it with a friend, a mate, and we complemented each other. I had a good job, which was providing enough income to service the mortgage, and he had just split with his partner, and they'd sold their house, so he had lots of cash and didn't have the sort of job I had. So we sort of put one and one together and bought the house. He put in a lot of equity, and I put in less equity, and then I paid the lion's share of the interest, and it was negatively geared. So, I think there's an element of problem solving you need to do with property, and I'm not saying it'll suit everyone, but sort of the old 1950s idea of waiting until you get married and saving for a deposit is not the only way of getting into the property market. And then the second point I wanted to make was after we sold that place, I used some of the equity that had accumulated, and it wasn't very much at that stage because we sold it about 3 or 4 years later. I bought an owner-occupier, and I helped to pay the mortgage on an owner-occupier, and I guess some of the equity maybe, but mainly the mortgage, by renting out 2 of the rooms to friends. So I was able to negatively gear 2/3 of the mortgage, which helped me. So, and of course, you do go into forced savings when that happens, but that's a good thing because it helps you to budget and save and think about trading off things like a new car versus an appreciating asset investment like a house. So if I think about how Jen, my wife, started, she bought a little 2-bedroom, flat in a red brick apartment block in Melbourne, and it wasn't a very attractive building to look at, but that got her into the property market. So, there are ways of getting into the market, and the important thing is to get into the market. And it doesn't have to be the house you live in for the rest of your life, but get started and work out a way to make it work for you using potentially negative gearing, renting out rooms, all that kind of stuff. So that's the first thing. I'm not suggesting that people are going to fork out $200,000 and buy $1 million place and live in it for the rest of their lives. So people have to get a bit creative, I think, with their circumstances and working out how to get into the property market. And certainly investing in QAV might be their way in. Hopefully it won't take them 10 years, but it might. The second point is, though, is to be careful about investing in the share market with respect to saving up for a deposit in a house, because as Paul points out, the closer you get to your goal, the more sensitive you're going to be to movements in the share market, particularly going down. And that's always a risk. And he's talked about tapering. I have no experience with that, so I can't really comment on it. But I think if it's almost impossible to time the cycles, either the share market or the property market, in the short term, except to say they both go up in the long term. So I think if you're investing in the share market in particular, you've got to be flexible, at least in terms of one variable. And the two variables are time and goal. So if you're, say, trying to save $200,000 in the next 5 years to buy a property, you've got to be flexible with one of those things. If you're investing in the share market, it might be that in 5 years' time you haven't got $200,000 because there's been a recession in between, or it might be that you get there in 6 years, or it might be that you get there in 4. So you've either got to be flexible in terms of your timing or in terms of your financial goal, but you can't be rigid in both, because even though over the long term the share market goes up at 9-10%, and I've been getting better than that, double that in the market. Not every year it's double, and so you can't have a short-term goal. So there's a couple of points I wanted to make. I can't really answer Paul's questions any more than that about my experience with how you taper out of the share market if you have a goal of saving for a deposit in a house, other than to say just don't be rigid. Just if you haven't hit your deposit in 5 years, you might have to wait 7 years, and if you might get there in 4. So just be flexible.
Well, just to add to that, when I was on a walk with Taylor the other day, and we were talking about what you'd said in last week's episode, Taylor said, well, what about his mum? The house that she and I bought here in Brisbane when we moved up here from Melbourne 13 years ago, we bought just before the GFC. Mm-hmm. And she got it valued, I think, about a year or 18 months ago, and it hadn't appreciated at all in that time.
Wow.
She probably bought it, she bought it, I was still in Melbourne, but we probably bought it at the height of the property market pre-GFC. And then in the last couple of years, it's come up with, it needs to be re-stumped. There's a lot of things that have, a lot of work that needs to be done on it, which is probably reducing the value of it as well. So I guess part of it is you need to be careful what you buy and when you buy it.
Yeah, definitely.
Right.
Yeah, we could do a whole podcast series on residential property as well, and what to look for. And there are podcasts out there about it, and newsletters and Facebook groups, etc. And but like I said, it's hard if you need a house and it's just before the GFC. You don't know it's just before the GFC, so you got to buy, right? So yeah. But it doesn't change the fact that I'm guessing she would have paid down some of the mortgage, so she can still release some equity. I'm not giving her financial advice here. I'm saying if someone's caught in that situation where the house hasn't moved in value over 10 years or 13 years or whatever, you potentially still can release equity and invest that outside of the house. Yeah,
right. Okay. So you would still have paid off some equity in that period of time.
Yeah, well, I think so, yeah.
Yeah, good point. Second part to Paul's email. I think we all wish we had the maturity to take up QAV at 25, but for most of us, the moment has come later. instead of wishing those 10 to 20 years back, however, why not encourage people to take them back? It's quite realistic these days with a disciplined approach to diet and exercise to wind the biological clock back 10 to 15 years. QAV compounded returns in this respect is a big health and fitness motivator for me. Buffett's wealth was impressive at 70, but far more so at 90. He may have done it on Coke and candy, but for most of us, and he's not talking about the good Coke and candy, he's talking about the mainstream Coke and C's candy, not Coke and nose candy, which is the same thing. But for most of us, a healthy innings like that is going to be built on applying QAV-style discipline to the way we invest in our bodies. Good point he made there. I know
it is. If Paul has any health tips too, I'd be glad to have him on the show and pass them on, especially if I can wind the clock back 15 years, that's for sure.
Yeah.
I'm guessing the Gronies aren't part of it though.
No. Well, maybe we need to start a QAV life extension club.
Yeah, right.
You should be investing in, what's his face's thing, Methuselah Foundation, the guy I had on my show all those years ago, my old show. What's his name?
Well, I know the guy you mean, Aubrey de Grey.
De Grey, that's it, yeah.
Well, the motivator for me was Kurzweil in Transcendent Men.
Yeah.
Which was a great book. And I came about that book through your G'day World podcast, which was excellent.
I had Ray on. Many years ago. Yeah.
Yeah. And then I actually met him at a conference after that too, which was
right.
inspiring.
Yeah.
But that was my inspiration for a long time was if you're healthy and can live long enough, you'll live forever.
Yeah.
It could be all hokum, who knows? But, you know, he preaches the rapture of the nerds and how if you can live long enough, your brain will get uploaded to the internet and you'll live forever. And there's probably an element of truth in there somewhere, although it might not happen for hundreds of years. But that was motivational for me. But yeah, I'm more in Paul's camp now that just seeing the sort of returns I've gotten over the years has made it motivational. And you think about the compound interest of living for 10 extra years, it's quite spectacular. And as he said, I think I don't know if it's still there, but at one stage you posted on our website Buffett's wealth over the years, and it's a graph that looks pretty flat and unimpressive right up until his later stages when it goes up almost vertically. And that's how compound interest works.
I mean, if you drill down into the graph and you reduce the y-axis, I think it's still pretty good in those first few decades. But, yeah, big difference between 100 million and 100 billion on the y-axis.
Yeah. But no, that's a really good comment from Paul. I wholeheartedly endorse it.
All right. Well, we've got a question from, might be the same Paul, might be another Paul. He said ANZ.
Sorry, before you do that, we haven't done Stock of the Week. Did you want to do that or just skip it?
Oh, no, we do. I skipped all your stuff and accidentally skipped that. Do you have any pulled pork for us this week, Tony?
Yeah, a pulled pork pull apart. My pull apart this week is an old favourite, Horizon Oil, which was on our list way back at the start of our podcast. And then if you recall, the AFR did an expose into them, which alleged that they were bribing Papua New Guinea officials to obtain oil licenses. And the share price tanked and we took it off. It was in the dummy portfolio, I think. But just in the last little while, it's made a resurgence and a couple of things have happened in the interim. So I wanted to bring us up to date, I guess, on that. So I kind of hadn't watched it for a while because I think that was going back almost 2 years ago or 18 months ago that we took it off the portfolio. But since then, and this is what the Horizons chair has said at their November AGM, I'm quoting, "We are pleased now that we have substantially put the allegations of 2011 corruption in PNG behind us. The board back in February reacted rapidly and appropriately by setting up an independent board committee, which then commissioned a thorough investigation conducted by Herbert Smith Freehills and assisted by Deloitte. The investigation, which reviewed nearly 1 million documents as well as forensic analysis of all electronic devices, failed to establish any breach of Australian foreign bribery laws." So there you go. They give themselves a tick. But I certainly haven't heard anything more about the bribery allegations since then. So that kind of has cleared up. This year they have sold off their PNG assets and they're now operating with a new oil well in China and one in New Zealand. So they've kind of just wiped their hands of PNG completely, both because of the legacy issues and they've sold off their oil assets there. Two things have happened recently. They've announced that they were going to do a return of capital. Originally, they said they would do a 1.4 cents per share return. I think that's right. But they upped it to 3 cents in the last little while, and that's split the share price up. And they've highlighted the fact that the oil price has been going up this year, as we knew that from Santos, which is in our dummy portfolio. As we recall, the oil price tanked during the COVID cough, and it's now back up over $70 a barrel. So that's helped. So they're funding their return of capital because of the rising oil price, which has put them in really good financial position. But then also too, I noticed that a company called Samuel Terry Asset Management bought nearly 20% of the company in June, and they've added a director to the board. So that may lead to corporate action. Someone taking a 19.5% or 19.9% stake in a company could be a passive investor, but usually it's the start of some kind of takeover bid for the company. But either way, it's a big vote of confidence in the company. And I guess I wanted to highlight that this is a classic Buffett-style contrarian investment. Take a good company, which we knew was good because it was on our top scorers list a couple of years ago, and when the management's distracted by something extraneous to the business, like in this case it was a bribery scandal, it depresses the share price and can often make it an even more compelling investment. So anyway, that's the kind of general learning that we can draw from this case. But it's had a recent 3-point trend upturn. It's now back up to almost where it was before the bribery scandal. It's a couple of negatives. It's now trading on a very high PE. It's highest in the last 3 years, so it gets a -1 in our manually entered data for that. It doesn't have consistently increasing equity, so it gets a 0 for that. And I'm using a share price here of 12.5 cents, which it was this morning, which is Monday, the 26th of July. And the share price makes a big difference to this company in terms of its QAV score, but the QAV score is currently around 0.1, and so it's on the bottom of our list. Last week when I came across it again, it was actually about 0.13 or 4, so sort of 0.5% increase in share price makes a big difference on the QAV score. It has a quality score of 58%, 7 out of 12. However, the fact that this new director has a 20% shareholding hasn't come through in the stock doctor data yet, potentially because it's part of an asset management company rather than just that individual director. But we could actually score it up a little bit because the director's holdings is now up over 20%. Price to operating cash flow is 5, which is good. PE of 14 is good. The book plus 30% is actually 12 cents per share, so it's just above that now, but if it drops back again, the QAV score will go up. We don't have any stockbrokers' consensus forecasts here, so we don't know what the growth is going to be. And the thing to be careful of, I think, is that is to time this. If you're thinking about buying it, if you're buying now, you'll get the 3% return of capital, but the share price may drop 3 cents as well because of that. But it's also possible that the share price drops a bit when the return of capital happens, but all other people start buying in as well, and the share price keeps going up. So because it's a compelling sort of story otherwise. But that's something people might want to have a look at. Not a recommendation, but back on the top scorers list.
Right. There you go. Pulled pork of the week, Horizon Oil.
Just one more thing before we go back to questions. I spoke before about Commonwealth Bank sort of flirting with its sell line. It's back above it. Last time I looked this morning it was. Macquarie Group is a stock I own. It's getting close to its sell line, so it's been doing the same dance that CommBank has. It goes above it one day and back below it the next, and then back above it. So I may well sell my holding in Macquarie Group this week. Time will tell. And the last one was last week, and I'll do a bit of maybe a deeper dive about oil when we have a week when there's not many questions. But the oil price was getting close to its 3-point trend sell as a commodity. It's now back up above that. It got down to, I think, about $68 last week. And my calculation of the sell was 66. And I'm talking Brent crude there in US dollars. It's now back up over 70. So it's flirting with its sell price. So just be aware of that. It may breach again before I notice it.
All right. Any other news you want to talk about?
No, I think that's enough, Cam. There's a few questions to get through.
All right. Let's go to Paul's question. It says ANZ have just announced a share buyback and CommBank is swimming in cash, apparently, ahead of an August report. I wonder whether Tony would consider those issues countering the share price downturn.
No, I wouldn't. No, share price downturn if it's gone past the sell line, it's a sell. Because the other flip side to the analysis is that with the banks in particular is with Delta COVID coming out and shutting down, probably the majority of Australia as we speak, the banks are putting a pause on writing back their bad debt provisions in case there are bad debts arising in the mortgage market. And the analysts were factoring into their numbers how much dividends might be raised and how much would be given back by the banks because of their high cash holdings. I'm guessing that's all going to be paused unless something dramatic happens to improve the lockdown situation before the numbers come out next month. But my gut feel says we're not going to see dividends increase or provisioning get released the way we thought we were before we went into lockdown and the share prices are going up.
Right. So rules is rules.
Rules is rules. Yep. But, and I think just one further comment about all this, when we're seeing companies like CommBank, which are flirting with their sell lines, and the sell line is kind of hugging that upward trend in the graph. We spoke about it before with Motorcycle Holdings as well. If Paul wants to hold them because he thinks they're good businesses for the long term and because he thinks that they've got lots of cash and they're going to increase their dividends or do share returns or whatever, or start share buybacks, go with it. I mean, the 3-point trend line is a line on the graph. No one in Macquarie Street or Collins Street sitting there going, oh, we're close to our 3-point trend line, let's do something. That's not how businesses are run. So, over the long term and on average, the 3-point trend line has done, great service to my portfolio. But it may not work in every case because it's a statistical thing. So just be aware of that too. You
won't excommunicate Paul from the fellowship of the Q? No.
No, and if he wants to come back and crow in 6 months' time because he's held on to ANZ and it's now worth twice what it is now, more power to him. That's fine.
Good luck to him.
Yeah.
So it's not easy to get excommunicated from the cult of the QAV.
No, you and I are both members. It's it's a low bar to entry.
Yeah. Okay. Yeah. You're saying he let me in. Mark asks, he's back to CBA here. A lot of CBA questions. Regarding CBA and the 8% flatline rule, for the buy line, instead of using April 2017, $87.40, and January 2020, $85.26, which has a 2.45% difference, you're using January 2020, $85.26, and January 21, $83.51, with a 2% difference. Both are less than 8%. What do you think
about the byline here, isn't he? The CBA?
The byline, yes.
Yeah. Okay.
I'm just, I think I double checked that and I think he was right. So I think my byline was dodgy.
No, I think your byline's correct. We're kind of conflating two rules here though. One is the 8% flat top rule. And the other one is the fact that the buy line should come after the sell line. So we may have to have a precedence order for the rules here, like, brackets come first and then multiplication, then division, and then addition and subtraction. But the way I drew this byline, I've got the CBA graph in front of me, is the highest price is around the current price, and we don't have a peak there, so you can't draw a byline currently. So I go and draw the sell line in first of all, and we spoke about the sell line is getting close to the sell price now. So we have a sell line. I'm looking for a buy then that occurred before that sell line.
Yeah.
So I'm going backwards. The next highest point on the graph goes back to April 2017. The second point, which would be H2, is January 2020, and they're within 8%. So then the next one I would look at would be, I'd start with H1 being January 2020, and I look across to January 2021. That point, I think, as Mark's pointing out, is still within 8% of the original H1 back in April 17. So then I would ignore it, and I would, if I then use January 2021, I can't get a peak to the right of that, so I have to back up. And then if I'm looking at that one, the next lowest point to the right is that peak we just spoke about, so you can draw a byline in there. If you don't want to do that because you don't want to use that peak because it's within the 8%, you can sort of work through it as going down from H1 of January 2020, H2 of July 2020, and then that gives you a buy that crossed at some stage during September of 2020.
Mm-hmm.
And that's occurred after the sell line was drawn. So that's all good.
Sorry, the sell line goes from L1
you're right,
March
yes.
2019 through December 2019 is how I've drawn it. Is that how you draw it?
March 2019 through to December. March 2019, you're talking about the sell line here?
Yeah, L1 March 2019 at $70.64.
Yeah, so this is working backwards to get a sell line before the buy line, for sure, yeah. So it's going through December 19, as you said, and then you get it across in February, so we're drawing a line after that.
Mm-hmm.
Yep. Then you get the sell line then going in at March 2020, September 2020, but they are within 8%. So September 2020 becomes L1, and then February 2021 becomes L2, and that line's drawn after that cross.
Mm-hmm.
Yeah, so that's how I'm drawing it. I think the byline would be January 2020 H1, and then July 2020 H2.
Mm-hmm.
But you could also, I think equally you could do it as January 2020 and January 2021 as well.
And just ignore the fact that they're both within the 8% variance, because that's all we've got.
What takes precedence here?
Mm.
Yeah. I think I'm inclined to take it back to that November 20. So sorry, H1, January 2020, H2, July 2020 line.
Yeah, that's how I've got it drawn on my chart here.
Yeah.
Okay. Thanks, Mark. Thanks for double checking our work, Mark. Always good to see people double checking our work. Question from Daniel. I know TK has the system to buy from the top of the list, but sometimes sees tailwinds, such as a spike in the commodity prices or gold, as previously mentioned. I want to know if he's ever been influenced by something like heavy buybacks or insiders buying heavily, which has related to some good success, or any other memories or insights he could share. Thanks, Daniel.
Yeah, so I think from memory, the only time I could think that we've gone down the list is two things, commodity prices, which Daniel's mentioned, So the copper price may have just turned up, so we're looking for a copper company on our list, which may not be at the top, but it's worth buying because the commodity underlying it is going up. But the other one I can think of was when a really good quality large cap comes on the list, like a JB Hi-Fi, for example. They normally come on at the bottom of that list, like a QAV score around 0.1 to 0.2 sort of numbers. And, I can be tempted to buy something in that kind of range because I expect it'll drop off the buy list pretty quickly as the share price goes up, and I know it's a good quality company and would be a good long-term hold. So that's when I'm tempted to buy from the bottom as well. In terms of buybacks or large director holdings, can't think of any examples of those, except to say that capital movements like buybacks or returns capital returns or things like that, or increased dividends or whatever, or special dividends, we'll probably see that in the share price appreciating, and it might bring something back onto the top scorers list, like a Horizon Oil, for example, is a classic example of that. But would I go down the list and buy Horizon Oil when it's at the bottom of the list, just on the strength of those kind of capital moves? No, probably not.
Right. But if there was a recent turnaround in the oil commodity price, maybe.
Yeah. So,
okay.
So I can't think of any other examples except for the fact that I have been tempted when a JB Hi-Fi or something like that comes along, gets on the bottom of the list.
Yeah. All right, thanks, Daniel. Murray, the broker I use often quotes a multiple of EV over EBITDA to value shares. EV, for new listeners, being enterprise value, EBITDA standing for bullshit earnings, according to Charlie Munger. I haven't quite got my head around the value of this metric, but it seems like it might be good as it combines pre-tax earning with balance sheet value. Wonder what Tony's thoughts are on this. Thank you, Murray.
Well, I think I have to address the Charlie Munger comment first of all. And I'm pretty sure from memory he made that comment during the dot-com boom in the late 90s when a lot of stockbrokers were pushing internet companies based on their EBITDA numbers.
Right.
Because they wanted people to ignore the debt that was being used to leverage them. And that's when Charlie called them bullshit earnings. And to a certain, and he's right. They are. And then Buffett would go on to a big explanation about why depreciation was important, which it is. The reason why I don't place a whole heap of emphasis on depreciation and amortization is because, again, a lot of times they're either governed by accounting rules, which they are to a large extent, but they're also, a lot of them are under the prerogative of management, how much provisioning you take up for those things, and that is just another example of why I don't think bottom line profit is necessarily a great thing to use when valuing a company, because they're subject to management's manipulation. To look at EBITDA is actually a reasonably similar metric to operating cash flow. It's before interest, it's before tax. It's basically what you've been selling less the cost of goods. So sometimes it's called operating profit. It's close to operating cash flow. The difference, I think, from memory, is that operating cash flow is the cost of the underlying business's operating profit less the cost of getting that profit. But it doesn't include some things which can be in EBITDA, which is one-offs or income or profit that's derived from things which aren't the core business. So, if they've sold something, that'll go through into EBITDA, but it won't be an operating cash flow, for example. So that's why, again, I prefer operating cash flow to EBITDA, but it's in most cases, we're splitting hairs there. So in fact, enterprise value, which is the market cap plus the cash minus the debt, is if you take enterprise value on a per share basis and you take EBITDA on a per share basis, it's in the same sort of ballpark as price to operating cash flow, right? It's because the market cap, is divided by number of shares as the share price. So it's share price adjusted for debt and cash, and it's operating cash flow with other things added in if they're sort of one-offs or not the main business. So it's a similar sort of metric, I guess I'm trying to say. So I think it's a legitimate metric. It's not one that I use. It's a little bit harder to calculate than price to operating cash flow, but I think if you were using it, you probably have similar results to the QAV metric.
So roughly ballpark, you get the same kind of value out of looking at that metric as you do price to operating cash flow.
Yeah, I think so. And I think price to operating cash flow, we're looking for a ratio of 7 or better. I'm not sure what EV to EBITDA would be, but it's probably going to be 10, something like that. It's again, it's like using PE ratio, except I don't like PE because it's profit and profit's open to interpretation. So it's kind of halfway between PE and price to operating cash flow, I guess, or part of the way along.
Yeah.
Yeah.
Oh, thanks. Thank you, Murray. Reg says he's talking about XRO Zero, which he bought for $38 and doesn't want to give too much away if it starts to drop. It's on a PE of 821. Great product, Zero. I use Zero. I think you use Zero.
I do,
you
yeah.
use Zero. Great product.
And ShareSide is based on Zero as well, or affiliated with Zero.
Good little Aussie company. Aussie? New Zealand. Aussie? Yeah.
It is now. It was New Zealand, yeah.
So if it qualified on QAV parameters, which it wouldn't, but if it did, it would be a buy pretty well now. There hasn't been a recent sell, so that would be the latest buy line, and the sell line would be shown with a sell of around just above $75, which seems too low for me to set a stop loss there. What do you reckon?
Well, I think the sell line's even lower than that. I've got it at $47 when I did the analysis this morning. Companies like Xero, I think, can fall into a little bit of your portfolio if you, like Peter Lynch, come across a new company and think this is really good, I'm going to buy it regardless of the valuation metric. I've spoken about that in the past. I think it's fine to have a couple of stocks in your portfolio like that. Like I've spoken in the past about, if I wish I'd bought Apple when I first started using an iPhone, I wish I'd bought Amazon when I first started ordering books with them. And certainly Xero, I thought pretty hard about buying the share price when I converted across to using Xero because it's a great product. Just the value investor side of me just wouldn't let me do it, but it would have been a great investment. So I think if they have a place in the portfolio if you're doing that sort of Peter Lynch one up on Wall Street. Hey, I've discovered a new product. I'm going to put some of my investment into it and see how it goes. And then the 3-point trend line is actually a good way of managing that investment. So if it turns down, sell it. If it doesn't, great. But the graph for Xero is so impressive, it's pretty hard to find what the buy line and the sell line is. Just let me have a go at it. So I'll call it up.
I've got the low point back in October 16 around $16.61, but then if I start to use the segment tool and I drag it across, March 2017 is about a 3.7% variance.
Yep.
The next low trough is, I think, August 2017, which is 39% higher. So I'm using March 2017 as L1 and August 2017 as L2, which gives me a sell price of about $75. Yours is lower?
Yeah, I actually went with February 17 and March 17. I think February was the last time we got within 8% of that low point. And if I use February and March, then I'm getting a sell price of 50 or 47 or something like that.
Oh, okay. I see what you're doing.
But look,
there.
it's so hard to see what the graph is because it's gone up so much on the right that the points on the left are really hard to read in this graph.
Yeah.
Yeah. So whether it's 47, 50 or 70, it's a long way from the current share price of 144.
I said to Reg in my email back, I think too with the 3-point trend line stuff, like the sort of companies that pass QAV muster have got really, really solid fundamentals, been generating cash a long time, et cetera, and are undervalued. And so if there's a market downturn and they start to come back, they're only going to come back so far because they've really got strong fundamentals. They're real businesses generating real products. They're mining stuff out of the ground, or they're manufacturing stuff, or they're banks, or whatever it is. Real businesses. My question around software businesses, internet businesses, is in a crash of that affects tech stocks, do they fall back faster and quicker in your experience than quote unquote real businesses? Or do they?
Well,
so
I think they do. I mean, the PE is, what is it, 800 and something, in the
21, he said.
Price to operating cash flow of 100 times. So yeah, I think they probably will.
So, when we draw the 3-point trend lines, we're drawing them for businesses that have passed QAV muster. A 3-point trend line for a stock like this might have to be different. Your stop loss might need to be a lot higher because the stock may not obey. In a cataclysmic event, the stock may not obey the same sorts of principles of physics that QAV stocks do. Right? Yeah,
well, I think that's the case. I think Xero is a good company. I just think the valuation's wrong, and then when you have and that's my opinion. I know there's plenty of analysts out there who'll tell me about it's all their profits being put into marketing and growing in the business, and when that share stops, then it'll be a profitable company. So I get that. You're banking on the future. You're banking on the current strategy getting to that future point, which I think is always has a certain amount of risk involved in that strategy, and Afterpay is another example that comes to mind with that strategy. And therefore, I think when you get pullbacks, they can be quite large because the fundamentals currently don't support the current share price. Everyone's banking on it being a much more profitable company in the future and getting to some kind of nirvana when they can stop putting all their profit into expansion, and then they'll throw off lots of cash, and that's all fine, but it's got to happen. And look, good luck to Reg. He's bought it at $38 and it's now $144, so that's fine. And also too, I think in terms of 3-point trend lines, if Reg wants to, turn the buy line up a bit and use some points which are closer to the upward trend and get a higher higher sell price, I think that's quite legitimate. Just depends on his risk appetite.
Yeah.
Like he could easily use, say, something like March 2020 as his second point, and maybe use something around October 18. So you're going to get a buy price which is about $100. That might be more realistic for a stock
sell
which
price?
Is going up so quickly. Sorry, sell price. So yeah.
But again, then you're just fudging it to suit your appetite for risk,
absolutely.
Right? You're just
it's a fudge. Yeah.
Pulling a number out of your ass and going, wow, that's all. It's not really any sort of 3-point trend line logic behind that, apart from, what do you reckon's a fair thing kind of stuff.
Yeah. No, true. Exactly.
Yeah, well, look, it is a good business, and I'm sure there is a whole bunch of logic behind why it's at the price it is. But the flip side is we know that the last 5 years, these tech stocks have just been benefiting from a certain state of euphoria, which history tells us has to end at some time.
Yep, and I'm guessing as soon as interest rates start to rise, they'll get tested. Which may happen for a while. Now we're in lockdown again, but yeah, it'll happen at some stage.
Yeah, thanks, Reg. Alice wants to know, would it be better to wait until reporting season to buy new stocks? I also have another query. Tony has mentioned it before that if a stock is a buy but it's still close to the sell line, you can wait for an uptick. Could you perhaps quantify what is an uptick? Okay, let's start with number one. Right about now, so we're recording this on the 26th of July, 2021.
Which is only days away from the start of the reporting season. I guess my general comment would be if I had to commit a lot of money to the market now, I'd wait. So like if I was starting my investing now, or if I came into a large lump sum through inheritance or whatever, then I'd wait. But I do trade at the moment, so I'm buying and selling. So we spoke about that. So like I potentially will be selling Commonwealth Bank, and then I'll replace it with another stock. But that, is probably only going to account for 5 or 10% of my portfolio. So I'm not making big changes to the portfolio now. But yeah, I think if you had lots to commit, I'd wait for reporting season and use new figures.
Right. But for anything less than 20 mil, you just get straight in there. Like any small amounts, you just play money.
Right. Yeah, monopoly money. Yeah.
Yeah. You're not going to worry too much about that. All right. Alice's part 2, uptick. We've talked about upticks a few times in the past. It's an upturn since the last. Okay. That's not a new upturn, but an uptick. Okay, an uptick since the start of the month.
Yeah. So what's a good example here? If I look at CBA again, which is flirting with its sell line. Where is it? I'll just call up the graph. And I'm trying to find an example here so I can talk about exact numbers. So if you look at CBA, right, the start of the month, the share price closed at, or the end of last month, it closed at 99.87. Today it's 99.09, and its sell price is 98 something, 98.50 or 60ish. So it's in this month it's turned down. So I would want, since it closed last month at 99.87, it'd be in an uptick if it was above 99.87. So I wouldn't be buying it new for anything less than $100.
Well, like 1 cent above 99.87, 2 cents, 10%.
No, I don't have any hard and fast rules. I'm just looking for it to be not below 99.87.
Right. Any amount above its previous close. Month end close.
I want to see the share price going up, not down, when it's that close to the sell line, which it is.
Okay.
And that's because if it's that close to the sell line, it's in a downtrend, it's heading towards the sell price. So you might be, selling out of it again straight away. So that's a bit of a pointless exercise, I think, because you're just paying transaction costs. So yeah, I'm going to wait until I see it in an uptrend.
All right. Thank you, Alice. All right. Well, we did have a few more questions that came in this morning, but we've got an interview with Alison Harrington coming up in a minute. So I think we might just push those till next week. Apologies to John and Elma and Dave from Newey on those, but I think we're an hour and 20 into this already, plus the interview. So we'll get to those. They'll be top of the list next week. And have a great week, folks. And you too, Tony. Enjoy another week of lockdown.
Yeah. Oh, my God. Thank goodness the Olympics are on. I can watch TV a lot more. Yeah. Well, I don't mind watching the Olympics. I like watching sport. What else have I watched? Gosh, it's been like my TV habits are getting worse during lockdown. I watched Loki, which wasn't too bad.
Started off as a good premise, I thought, but rapidly just sort of went nowhere. It's kind of just became Matrix-level convoluted silliness, I thought. But, Owen Wilson's always fun, and Tom Hiddleston's great, but they didn't give him much to do, I think. He's much better when he's being cunning and evil. When he's just sort of the nice variant, I didn't think it didn't work as well.
Yeah, no, I agree. He was being a bit redeemed, wasn't he, as a good character?
Yeah.
Yeah. And the bad one came back in because there was other versions of Loki without giving too much away, but which was good.
It's good to see the old Withnail and I guy in there.
Richard E. Grant.
Richard E. Grant. He's always fun to watch.
Yes, always a huge overactor.
Yes.
Loves a good bit of, loves a leg of ham.
I've always said he would have been a good doctor. They should have made him the doctor.
Yeah.
I think he'd be great. He's got that level of campiness and over the topness, which would be great. Yeah,
no, I agree. And Owen Wilson reminded me of the other actor, the grey-haired guy from Mad Men.
Oh yeah, I know who you mean. Yeah. Richard?
I thought it was him when I first saw it.
Yeah, right. Bit of a silvery, spiky hairdo.
Yeah, no, exactly. He was good. No, I didn't mind it, but haven't found much else to recommend. I got sucked into watching Lux Listings in Sydney. That was, probably the first time I've ever watched a reality TV show. But it was a good postcard for the area I live in, so it was...
do I need to stage an intervention for you before you start watching, like, Real Housewives of Beverly Hills or something? Like,
What channel's that on?
I don't know. I don't have a TV. All right. Well, as I told you off air, we watched, I watched Oliver Stone's Platoon finally over the weekend, which I'd never gotten around to watching, and I kicked myself because it is bloody great. What a great powerhouse performances from everybody. Great film. Good.
One of those movies film. I went back and watched it about a week after I first saw it. It was just so
right. Good film. Charlie Sheen before he went nuts.
Yeah. And check out Salvador. That's probably even better, I think, than Platoon. It's a fantastic movie. Yeah. Back
to Platoon, though, like, interesting, Charlie made that about 10 years after his father made Apocalypse Now, and it's a very similar sort of role in some ways. Like, he goes on this journey in Vietnam and comes out of it just, has to kill an American officer and comes out of it just sort of, I guess, like, whatever, a little bit broken, a little bit sort of despondent or given up on the dreams and the illusions. Nice to see him sort of almost replaying his father's role.
Yeah.
Okay, Salvador.
Oliver Stone speaks about that in his Chasing the Light book, which is really good too.
I'm going to read that. I'll watch Salvador and then get a copy of that. All right, I'll report on Salvador next week, let you know what I think. All right. Cheers, mate.
See you. Bye.
Today we're joined by a guest, Alison Harrington. I had the opportunity to meet Alison at a Brisbane Australian Shareholders Association meeting several months ago, and she talked about her experience as a value investor of many decades and shared with me her thoughts on women as better investors than men. And I thought we absolutely need to get Alison on the show because we have been rightly criticised by Tony's wife and others for not having enough women guests on the show. In fact, any women guests on the show. I think you're our first, Alison. So maybe you can help start a trend of correcting that. Welcome to the show, Alison Harrington. So, Alison, if you don't mind, give everybody a little bit of a background on yourself and your investing experience.
We've been an investing family for 2 or 3 generations, more on my husband's side. And in the 90s, my husband became very unwell. And at around about the same time, my mother-in-law was introduced to the Australian Investors Association. The family were brought up north of Julia Creek, 90 miles from the nearest town. So my mother-in-law was very pleased to actually be able to see face-to-face other investors. And so she brought her entire family along to Australian Investors Association conferences. And because I was in Brisbane, I ended up starting to go to the meetings. And that was 1999. So I've been going for 20-odd years. And so now most of my time is spent with the Australian Shareholders Association. But I've been an active member of both since 1999. And the first event I went to, I'm listening to them talking about fundamental and technical and psychology of investing, and I'm thinking, oh, hang on, there's words here I don't really know, not being and so from there I got involved, and I sat there very quietly for 5 years. I didn't say a thing. I used to sneak into the meetings, sit at the back, and people laugh when they know me now. And then eventually I was asked to be part of a strategic review of investing education. And from there I just got more and more involved. And I think the advice that was given at that first conference was probably still the most important advice that I've ever had. So it was understand your psychology, have a goal, know what you're doing, know what you want out of investing, and have systems. So have a review process. So set up a system that you can review, and then you can amend and change it. If you're an emotional investor, you have nothing to grip to actually come back and say what went wrong. So it's been an evolving experience since then, and of course it used to be you basically relied on your stockbroker for information and reading the financial papers, and now of course we have an amazing range of information, but in an odd way a lot less active retail investors. There seems to be so many people out there advising that concept that the individual doesn't really know what to do is almost a stronger one than it used to be. So it's changing all the time. I love it. I love being involved in seeing what's happening, working with the changes that are happening in our society, working with the economic changes and the values and the new generations that come through and the new technology. It gets you involved in every single day. And, of course, I love being financially independent. That's the best answer of all.
Hear, hear.
Do you remember who it was that gave you those sort of starting tips that you talked about?
Well, that was interesting because not one person had the whole lot. Mm-hmm. They were a bit from this one and a bit from that one. Everybody had their own little box and platform that they were speaking from. The guy that was the most impressive was a psychologist from Tasmania called Harry Stanton. I think he called his book Let the Trade Winds Blow, but he made the comment that there are two things that test you as a human: getting married and being a responsible investor. And he's right.
I think you mentioned to me after the ASA meeting that you were quite close with Roger Montgomery in his early years.
Oh, Roger was one of the presenters on that night. That's 20-odd years ago, so Roger was a baby then. And it's been fascinating to watch Roger's journey as a major influencer in the investing stream, and the ups and downs and the journeys we all take is almost a mirror of everything that we all do. And, of course, his book, Valuable, is a great read for people who really want to think about value investing. He used to have what was it called? He used to have a formula so that you purchased this formula for $99, and then you went into every share that you're interested in, a company that you're interested in, you extracted all of the data, and then you punched it all into and put Roger's formula on it, and it gave you the magic figures of the range that you should buy that share if you're interested in buying. It was great fun. It actually was a really good tool. I enjoyed it, but of course that's long gone now. Could do all that just with algorithms so quickly. You
learned a lot from from Roger's book, didn't you, Tony? We had him on the show.
Yeah, it was a great book.
Just before really the COVID crash, actually, and you talked about it.
Yeah, no.
I've actually done a 14-hour one-day course with Roger. It was only meant to be 10, but he didn't stop talking. We kept on saying, Roger, we've got to go home. It was wonderful.
Yeah, no, good book. And I think he ran Climb Investment Management, I think.
Yes, he started Climb.
Yeah.
And then he moved over to Scaffold.
Yes, that's right.
He said the vicissitudes of life. That's why he had the book, because between it, he wasn't allowed to practice, so he had that year to write the book.
Right, yeah. And he used to be regular on the ASX podcast series when podcasts first came out, which was also a great resource as well.
He also put me in line of another little book, and I can't remember what it's called, but it was written Understanding Cash Flow, and it was written for the point of a fence. So you have a fence, and what each post stands for and what each rail stands for. And it's a great way of thinking about where you really focus on your cash flow. Because one of the difficulties that so many people make in business, they think that their cash flow is profit. and that's definitely not the case. But it was a privately published book. It was never out there on the market, but it was a fabulous tool as well.
And I'm guessing if you're a fan of Rogers, you're a value investor. So why value investing over other forms of investing?
It's a lot more than just value investing. I mean, I've read a lot of stuff on Buffett, and in fact, my first introduction to Buffett was reading Katharine Graham, who owned the Washington Post, her autobiography, which was one of the best reads I've ever had. And she talked about Warren Buffett because he came in and worked with her, and that was actually long before knowing about Buffett through Roger. I think it's more than just value investing now. You've really got to understand what value is. But value is not just a figure. It's a clarity of purpose. It's strategy. It's good management. It's having a future and knowing how to build on that future. So value is actually working out, yes, is this company overvalued if you want to buy it? But value is so much more than that. It's not just, is it the right time to buy? Quite often at times I've made a decision not to buy something because I thought it was overvalued. And, CSL is the classic one of that I can espouse on that one. And thought it was overvalued at $6 and $30 and $60. And so it's a lot more than that, but it is an essential tool to actually understand what you're doing as far as an investing, as far as a company goes. But it's also about how the directors really understand what they're doing and whether they have clarity. And then the other word for value is, do they have good values as human beings? And then technical is really all about your emotion. It's about when do you buy and who else is getting involved in this market, and each stock has its own technical story as well. So it's a complementary tools, both of them.
Can you take us through your process then, Alison, when you're analysing a stock? I think you mentioned to me at the ASA meeting that you have some form of a checklist that you work your way through.
Yeah, so the classic three is it big enough and liquid enough, and do I understand the business would be the first three things that you look at. So, and then starting looking at what I've sort of ended up over the years working out which one, I can't remember off the top of my head now, but which one are the main things. But it's really consistent growth, and if there isn't consistent growth, an explanation of why there is not. So I think if you remember, Wesfarmers was doing really, really well, and then they bought Coles, and everybody said, oh, they've messed it up now, so the share price almost halved. But because they weren't consistently getting that return on equity. But of course, in the end, that was, a way of coming down and then building up again. So it's that I prefer a 10-year history, so I can actually see how long it's taking for a company, how they're going over a longer period. And, in 2007, of course, we had the GFC, and now we've just had COVID. So you need to make sure that you've always got those major events and seeing how people have responded to those major events. And also to see how the share, all those values have changed over different managers and different way the company's being run. So it's really consistently, and if there's not a consistent story, if there's a glitch somewhere, why? And as I said, like Wesfarmers is your classic one, why that glitch happened. It's because they bought in to Coles. And sometimes, and then looking at how they value the share price and the number of, whether they're keeping on increasing the number of shareholders, your value. But I'm particularly interested, so value for the shareholders. I'm particularly interested in, are they generating enough profit that once they've paid me a dividend, are they going to still be able to grow? I want a company to be twice as big in 10 years' time. They've got to have cash flow to do that. So, the old cash is king, but it's also how you manage it and how you put value into it.
So there's some of the key things that you look at. So over that 10-year period, are you pulling down their financial data and then throwing it all into a spreadsheet and just making sure that it all looks good? What's your actual process?
I just use a tool. Somebody else pulls it all out there and it's all there, and I'm looking for patterns. So I'm not drilling down fussed about particularly individual, because I've done my first filter with the first three: size, liquidity, and do I understand the business? And then as you go through each line, you can actually start filtering other companies out. It's very quick to then start, look, their free cash flow is just going nowhere. Their sales per share is not increasing. So you can start pulling all of those things out, and you start end up with a very small number of shares. So then it gets easier. So then when you've done that, then you start looking at your bigger pictures like debt to equity, how they use their cash flow, and just making then starting to look at the how the companies run, their culture, their values. I don't really go into those at the early stage. They're more once you've narrowed it down to a number of different companies.
Right. Tony, do you have any questions for Alison about her process?
Do you, you said the one I wanted to focus in on was understanding what the company does. So do you have any particular industry expertise that you rely on, or are there industries you just give up on because you'll never understand them? Is that part of the process?
If you look around in your daily life, there are so many businesses you understand. You understand how banks work, and you understand how real estate works. You understand how retail works, and you understand what products you're using, whether you're buying beds or toilet pans or whatever. So there's a lot of stuff. Generally, the mining industry. I was brought up in the generation where the mining industry was an incredibly large part of our country. We've lost a lot of our manufacturing. So looking at, what minerals are out and about. We ran a seminar once called Mine the Miners, which was wonderful, just talking about how you understand the cycles of mining, and when to pick up and when to back off onto the mining industry, because everything is cyclical. Looking at, some shares are they have high volatility, so their opportunity to buy and sell. They're very solid businesses, but they're influenced by external factors. So you might want to buy into them when they're low and sell when they're high. They're cyclical, so that gives a different type of stock. Others you can see them just growing. Others you can see them growing and getting to the point. So you've got to think about, I'm moving sideways out of that one. So there's stocks you keep and stocks you move through, stocks you speculate on, and stocks you just got to have a bit of fun with. You've always got to have a couple of splurges there that you just want to watch and see what they do. But I think for my generation, the boom in the last 10 years in the technology industry, and the ASX all techs sector is. It was started with 25 stocks at the beginning of last year, and there's now nearly 100 stocks. So the boom in the technology stock is just another whole game, because there's so much happening there, so that you don't see all this, like Atlassian, all that software program behind that, as a person sitting in front of your computer, you don't really see all of that. And but also when a company is growing, like Xero, and Amazon, they don't make profits for years and years because everything goes back in. Well, when you bought up to always look at a company that's got profits, then it's changing the way we're looking at those companies is a different ballgame.
Does that mean you would buy shares in Xero or on Amazon, or are they companies you just don't really understand?
Oh, no, I understand them. I just never talk about what I own. It's one of the rules within the organisation of ASA and AIA. Nobody should feel obliged to talk about what they own. That's up to you if you want to, but, I just have a rule. I don't talk about what I own. I find, to be honest, as soon as you start talking about what you own, the area of competition comes in. So people want to always tell you the story about how they got into it better or brighter or whatever. So it's just easier to stay out of that. Investing is such a personal journey that to be influenced by other people's competitiveness is not going to bode you well. And that's really underlying why women are, according to research, make at least 1% better return than men, because they're not actually competing with each other or with the market. They're just working away at it. And I know some very, very smart women investors.
Well, I wanted to talk about that because you mentioned that study to me. Can you tell us a little bit more about what you've read about why women are better investors than men? Is it just because they make better decisions because they're not as competitive?
I think that's one thing, but I also think they're just a little more quieter about it because they're not interested in being up the front and being look at me. So I find that most of the women I know that invest don't talk about it. They keep it very quiet, and then every now and then, there are groups. I don't belong to the two other groups, and where you actually talk about your own investments, and I said it's just my personality. But there are some very smart investors, but they just tend to just quietly work away and keep their own thing. I think the sad thing is there are not enough women investing for them to be. I've got a little cohort of women that are friends who invest, and that's about all I really interact with. You never know when that next piece of joyful information that helps you choose the next good winner stock is going to come through. It can come through from anywhere. I think women, having now observed the investing industry and seeing I've been to so many conferences and seminars, and we've had so many speakers to see. Some of the women speakers have just been extraordinary. I've heard many times that some of the best speakers in Australia. And I think that we really are targeted with an underlying image that women, that money is men's business. And I've actually heard men say this, that money is men's business. And I think that that's an underlying philosophy that it's easier, therefore, for a woman to just keep her own counsel and do her own thing, pick the brains and get on with it. And it's, it is, I think, becoming even more so because there is so much money around that's being managed through the superannuation industry, which of course changes the dynamics of our investment community as well. But they're all personal opinions. There are many, probably other women I'm not running into who are very active communicators with each other.
What do you think you would change to encourage more women to manage their own finances?
I have asked that question so much. I actually did spend time for a few years developing a website that was aimed just for women, and it was based around the concept that women do need to learn and be confident before they will speak out. So they do need to learn in a quieter situation. I think that or every volunteer organisation, every person who's educating people about investing, even people who have knowledge bases that are teaching people, they really need to focus on how to get through to more women. It's well documented now that in America, the generation of women over 55 are now manage more than 50% of the wealth of America, and they are not being heard. So that's a lot of it through inheritance, a lot of it through their own businesses, but that's not being heard. So I think there's a huge need for the industry to really think about how women can be empowered and educated, and it's about that empowering women to make them understand, you actually can do it. You don't have to be a genius at mathematics. You don't have to be a genius at understanding how a business runs. You just have to have a system and not be frightened to ask questions. And that system should be evaluated and changed and adjusted as you learn more and as you become more and more experienced. And even if you just know enough system to be able to really get your advisor to fight for you and to give you the best deal, and not be someone, that they don't really care, so we won't push them into that extra REIT or ETF that just might make them that bit of extra money. So yes, don't undervalue women is really what the industry needs to do, and the media.
What can we do to attract more female subscribers to our show on investing?
I really think if you are really keen on it, have an introductory session on a regular basis that's focusing on those barriers to entry for women, and don't talk down to them, but that sense of empowerment that that women can do it. We see so much advertising that you go and buy a $1,500 pair of shoes, or a glitzy piece of jewellery. You just don't see those stories out there about that $1,500 pair of shoes could be worth, when you're 50, $60,000, $70,000. It's not there in our language. It's not there in the conversations of a daily life.
We need to make a TV show like Sex and the City, but it's just the four women sit around saying, no, we're not going to waste money on Manu Blahnik shoes. We're just going to invest that and start talking about compound returns. For those people listening to our show who aren't members of the Australian Shareholders Association, what would you say the pitch is for becoming a member and going along to your get-togethers and meetups and conferences, etc.?
You don't need to know anything to start being a member. There is no expectation of knowledge. You can do what I do. I did sit there for 5 years and say nothing. The most important thing is that they are not pitching a particular story. So it doesn't matter what type of investor you are, or how much you've got to invest. There will be resources that come through the ASA that you're going to grow as an investor. So one week we might have someone talking about green investing. Next week we'll have someone talking about bonds. The next week we'll have someone talking about their system for selecting shares. Next time we might have someone talking about the mining industry, Bitcoin, investing in technology. It just goes on and on, the range of things. And that's just in one meeting. And then you throw into that the webinars that are available, the reading available, and then the seminars and the conference. Seminars don't happen as much since COVID, but we used to have 3 seminars a year, half-day or all-day seminars, as well as the annual conference. Great opportunities to just passively learn, and you never know which meeting is going to make you that bit of extra money. I remember one meeting going to it and discovering that there was this one little thing so that you had that one opportunity, and I made $15,000 just by tweaking my tax return. And another time there was an advisor, someone was looking at something differently, and I made enough money in 4 months to buy a new car. So they weren't stocks I wanted to be in long term, but they were just undervalued, and so I made an opportunity. So, and you never know. Then you might go for a year or so and not know anything, and it's just the joy of being with like-minded people who care about being financially independent and valuing their own ability to be able to manage their own finances. And that's that underlying being with people who actually have the confidence to do it is just a phenomenal feeling. And it's a delightful, both Australian Shareholders and Australian Investors Association are both delightful organisations. They both have the same values. Australian Shareholders has the extra role of advocacy and company monitoring of companies, and they've made some quite considerable differences in how boards perform in Australia.
At the few Brisbane meetings that I've been to, and also the annual conference, the age of the attendees, the demographic seems to be on the older side. Do you have younger people joining the organisation, or that I've just not have done a visibility of, or is that something you're trying to do more, as attract younger folks?
It's definitely something that we need to work out how we're going to do it. There is a little bit of a restriction in that because we don't have a system that we advocate, we just expose you to everyone who has systems or ideas and all different forms of investing. It's hard to actually create, this is what you should do as a brand new investor. It's not impossible. But we're a volunteer organisation, so finding people who are willing to not only run what is already being run, but add in formal work. And the Australian Shareholders are just starting to move into that area to actually, they've created a new position that will be responsible for education. And then we've done a big survey on women and W Invest is a new organisation that a section of the organisation that they've started, but they need to work out what to do with the young ones. They move much faster. They're so much more tech savvy than grey-haired generation, and they need something to capture them that bit quicker. They have that very short attention span. But it is essential that young people start, because they're the ones that get the value of compounding. You know, it's such a difference if you can actually get moving early and have money in the bank that hit your 40s, and instead of thinking, oh my gosh, I've got nothing to retire on, to see that your mortgage is starting to come down, your investments are growing, and you can actually start seeing you have choices in your life. And I think that's the joy of investing young. You can actually A, have time to make mistakes, and B, you can have the joy of seeing the growth of companies that are growing with you, and your net wealth is growing, and so that gives you those choices. And hopefully along the way you'll find that stock that you'll pick up for 20 cents or CSL $2.50, now $280. You know, these stocks do come through, but you can't invest in them unless you're actually in the stock market. And I think the other thing I would say for young people, the ASX learning to invest and their competitions are phenomenal, but I only think you learn if you put money in the stock market. You know, you can theorise as much as you like, but unless you actually are willing to put money in the stock market, you're not really going to learn. And it's a bit like going to the horse races. What's the point of going to the horse races if you don't have a bet on a horse? It's the same thing.
That's one of Tony's favourite pastimes, isn't it, Tony?
It is, yes, that's right. Yeah, although I did go to the horse races in Dubai once where you're not allowed to put a bet on because of the Muslim religion, but that's a different thing.
But they have races anyway.
World Cup, yeah, Dubai World Cup.
Oh, wow. Do you have any last questions for Alison before we let her go, Tony?
I think you were going to ask Alison about her biomedical experience, is that right? Yeah.
Yeah, you're involved in an organisation doing some interesting work that you told me about. Could you tell us a little bit about that before you go, Alison?
Yes, it's interesting when you go, if you went to a doctor and you had symptoms of diabetes, they would ask you all their clinical questions and then they would send you off to a blood test and they would decide, which would tell you that you have diabetes and how severe it is, and that would be used then, regular tests, to manage the diabetes. If you have mental health issues and you go to a doctor or a psychiatrist, they have no objective measures that says, yes, you have changes in your body, physiological changes. We can put a measure on those. We can then give you a treatment plan, and then we can retest to see how your body is physically responding to the treatment program. And so we've been involved in original research. We have some brilliant researchers in Queensland, and we've actually done world-leading research. So we actually have the beginnings of just a very simple process that gives some very nice tools for the medical profession to work with. The most important thing about it is that, you know, when you become suicidal or depressed or whatever, you just think, why me? What's happening? And if somebody says, look, let's measure this. Oh, this one is way off the tree. Let's do something about it. It's empowering. So you feel like you've got some chance of actually repairing your system. But you won't hear about us because we've been quietly doing this research, and there's no point in research. Is no use until it's actually happened, and we're just at the beginning where we're starting to actually talk about it and teach people about it. So we have online courses for doctors now that actually quietly teach about this. I can't rush into it because it takes a while to understand how to manage adding these objective measures. It's been immensely rewarding for everybody involved, and hopefully we will end up being part and parcel of the system when you when you have issues with mental health. If we can do anything to reduce suicidal tendencies, that would make an enormous difference. But research and all of this is all ahead. We have to prove the biochemistry, the physiology, start with the science, start with the base, the groundwork, and that's where we're working at the moment. So that's why you don't hear about us. We're just doing the rock solid stuff behind the doors.
Is this a company that you have set up or chair, or what's your relationship?
I'm the chair of the organisation. It's a not-for-profit charity.
Okay. What's it called? Are you able to say?
BioBalance Health.
BioBalance Health.
BioBalance Health. We run online programs for medical doctors.
Nice.
We train new doctors, and then we continually upgrade the work for doctors who've already done the training. And they're a pretty impressive bunch of doctors.
And you'll let us know ahead of the IPO. Give us some more help.
One of our doctors actually did a research paper. He was dealing with a lot of schizophrenic sufferers, and he found that 650 patients, I think about 180 of them finished his program using the objective measures, and their average stay in hospital went from 20 days a year to 2 days a year, just by being able to look at the objective measures and managing those and encouraging the body to repair itself. So that was a pretty good outcome. But it stops them from thinking that there's something
wrong with them. They're a bad person. They're a broken person. But no, there's just something going on with your biochemistry, and we fix that, and you'll be back to normal.
Same as there is with diabetes. Yes. Same thing.
Yeah. That's That's great. Well, getting in on the ground floor of the IPO would do something about my depression. I can say that, but I don't want to make light of it. That's
making
sounds
a better,
like,
and your return on your investments is very good for your depression as well.
that sounds like terrific research. Well, listen, we'll let you go, Alison. Thank you so much for coming on. Congratulations on the great work that you're doing with the ASA and on your own investing as well. And hopefully we'll be able to figure out how to get some more women on our show and involved in investing. Tony and I will have to sit down and figure out how we position ourselves to get more of the ladies.
Well, you can always, I've put a huge amount of thought into this, so always happy to chat to you and encourage you to do so.
Good.
Thank you.
Yeah.
Thanks,
Come back
guys.
anytime.
Lovely to meet
and if
you. Thank you for inviting me on and get those women investing.
Thanks,
Yeah,
Alison. You
great
come
stuff.
back at any time and talk to us. And if you have any other colleagues or people you invest with who you think might be good to come on the show, please point them our way.
Yes, I actually do have a couple of ideas. So they're quite quiet, so they might not, but there are some quite smart women.
Great. Yeah.
Fantastic. Well, we look forward to having some of those ladies on. Have a good afternoon.
Brilliant.
Cheers, Alison.
Thanks,
Alison.
Tony.
Thanks for your
Anne.
time.